thank you all very much for coming. And then I want to thank my fellow contributors. We had a launch party in the book at lunchtime, and there were 6 of the contributors in the room, not quite so many this evening, but ladies and gentlemen, I don't want to shock you, it wasn't a case in which more than half a dozen economists agreed. In fact, there are a lot of disagreements, but I hope that increases the interest of the book. And then I also want to thank the Institute of Economic Affairs, which actually has an event here in November 2013. It wasn't really a conference, but anyway, the contributors all offered papers and spoke and things at that, and some of them even understood what I was saying. Now, we're in the Selden room of the IEA. It's actually quite a historic room, since this is where Arthur Selden used to write the pamphlets that then propounded the free market message. And there certainly was a period from the mid-70s through to the, I suppose, the mid-late 1990s, in which the case for free market ideas was very much gaining ground, both at the intellectual level and also in policy making. And then, since then, there's been a check, and I would say that there have been 2 events in particular that have been responsible for that. One was the Asian crisis in 1997 to 99. Capital controls coming in Malaysia, etc., and the breakdown of the so-called Washington Consensus about economic development. And then, much more important, we've had the Great Recession now almost 10 years ago. So we've actually, in some ways, what's not ways is not working, because I've got it right way around. That's not right. There we are. So we've had a return of anti-capitalist, anti-market sentiment in various places. And there was an article in the Telegraph just yesterday morning by Philip Johnson saying the time has gone when the consensus is moving towards a belief in greater individualism and more self-reliance. The 2008 crash brought the prevailing mood to an end, leaving people vulnerable to those selling big state solutions and the avuncular arm of government around the shoulder. Okay. Now, so the question is, what's going on here? And one of the problems is that an event like the Great Recession tends to get blamed on capitalism, and particularly on the financial system in capitalism. And this was very much the same as what happened after the Great Depression in America and then the 1930s. So obviously the late 1930s in Europe, Europe polarized between fascism and communism and so on. That's not been what's happened this time, mercifully, but one of the books that then changed thinking about the Great Depression was some years later by Milton Friedman and Anna Schwartz, Monetary Systematic States, which came out in 1963. There had been this tendency to blame the Great Depression on the banking system, on bankers, and then on capitalism in the large. And what Friedman and Schwartz did was to say that the Great Depression was caused by a collapse in the, well, not just in the rate of growth of quantity of money, but in the quantity of money, quantity financially fell. And this was the result of incompetence by a state-sponsored institution, the American Federal Reserve. Now, just so you know what this evening, what this book is about, what this book is about, that's all I'm saying about the Great Recession. The Great Recession was again caused by a collapse in the rate of growth of the quantity of money. And all I see myself doing really is updating Friedman and Schwartz to the more recent past. I don't think I'm saying anything very startling or original, although surprisingly I seem to be the first person really putting this all together. As I say, the other contributors to the book don't necessarily agree, so you've been warned. there's been what I call the mainstream interpretation of the Great Depression, which says that the Great Recession, what happened in this period was that banks either went bust or were liable to go bust. They needed help from central banks, the government, they were bailed out. Fragility in the financial system led to a loss of confidence, led to a reduction in spending, banks were going bust, and so on. Now, I regard much of this stuff as that final word of abuse journalism. Anyway, despite the fact that this was, in my view, not very clearly substantiated by the facts, it did lead to general agreement about the answers. And the answers were supposed to be tidying up bank balance sheets, and in particular, banks had to be safer, so they needed more capital. And in particular, they need more capital relative to their risks, so they should have an increase in their capital asset ratios. There are even some people who recommended deleveraging, which on some means actually reduction in the size of bank balance sheets, etc. Now, this raised the question of whether it was true that banks were short of capital at the start of the crisis and whether they had great losses. I don't want to talk all evening, it's a huge subject, but this is a chart of the ratio of equity capital to the assets and liabilities in the American banking system going back to the 1930s when the American Federal Deposit Insurance Corporation was set up. I've got to move quickly, there's only one country, but America is very important. You can see that the period in which the capital asset ratio was very low was actually the 1980s, the third world debt crisis. Some of us here, I think some of us were working in banks at the time, and in the third world debt crisis and so on was actually, American banks were indeed very short of capital then, and frankly, many of the American money center banks were indeed completely bust. It was managed, and the loss had taken after banks had retained operating profits. Look, this is 2006. US Bank's capital asset ratio in 2006, ahead of the crisis, was higher than at any time since 1939. These are official Fed data, they're very easy to run down, they're maintained on a quarterly basis, etc. It's just not true that US banks had a low ratio of equity capital to their balance sheets at the start of the Great Recession. I haven't got a picture here of the UK banking system. Can I just say that the UK banking system at the start of the crisis, take from the end of 2007, had equity capital of £175 billion. And if you take the whole banking system, I mean, the big banks anyway, not some of the smaller institutions, all the big 4 or 5 institutions, HBOS went into Lloyds, etc. The losses of those banks that had losses totaled 35 billion, much less than the starting capital of the system, and over the whole period, UK banks had profits of about £60 billion. Much less than the previous 6 years, by the way, but they remain profitable. And as in the American case, the capital asset ratio was rising all through the Great Recession, Great Financial Crisis period, under regulatory pressure, as we'll talk about soon. Can I put it to you that logically, on that basis, these banking systems of 2 quite important economies actually had ample capital at the start, and they weren't short of capital, and they didn't go bust either. All right? So this whole basis is in my view wrong, and in fact the much better explanation for the Great Recession is the monetary interpretation. Now, one thing, this is not journalism. It's based on a standard theory that levels of national income and spending depend on the quantity of money. This theory can be tested with large bodies of evidence going back over many decades in many countries. And one of the implications of this theory was that the right way of dealing with the emerging problems in 2007 and 2008 was a large increase in the quantity of money. That did in fact happen, but only after all sorts of mistakes had been made. Anyway, just to try and understand what's behind this, I have to mention this chap here, who I first met, by the way, in this room a long time ago now. It's very simply that the dominant driver of nominal national income in the long run is the quantity of money. This is, again, American numbers. It's a period going back to 1960, actually going back to 1959, but the rates have changed first in 1960. And the changes in money and nominal GDP are not the same. Well, it's not that perfect, but they're very similar. And you can see when there's rapid money growth, there's rapid growth of nominal GDP. Not always, but in general, when there's low growth of money, there's lower growth of nominal GDP, and so on. That's really, this proposition is based on evidence, all right? Whether you want to call it scientific, perhaps a matter of taste, but assets are simply a capitalization of an income stream. Obviously, the income streams are part of national income, so it's likely that if national income depends on money, then so does national wealth. The prices of goods and services depend upon money, so do asset prices. And this is something that I have, thank you for the IEA for publishing this over 12 years ago now, gosh, about the link between money and asset prices in boom and bust. It's one of ideas that Keynes pressed as well, but anyway, let me, just before I finish on that, this was something that at lunchtime we had Keynes' biographer there, and there's one or two exchanges between Robert Skidelsky and myself about Keynes. Never mind. Keynes certainly believed that asset prices are determined by money, and much of his analysis of the 1930s was very much about this link. Anyway, now the three key items of evidence. I haven't got the 1930s numbers with me, but this is the rate of change. The blue one is annualized 3 monthly rates. If money growth in the 3 month period was continued for a year, and then the annual changes. This is M3 broad money, and I know there's lots of theology and debates about that. This plunge in the rate of growth of money from late 2007 through to 2010 is the steepest since the 1930s. All right. There was another period of instability in money growth in the early 70s, again associated with a surge in inflation and then a slump. Well, a serious recession. At any rate, this is the most volatile period of rapid followed by a collapse since the 1930s. Then what about the Eurozone? Eurozone was relatively okay early on in the crisis, and in fact a certain amount of, what's the right expression, Schadenfreude, yes, how's the word I was looking for? Because the crisis was supposed to be very much a British crisis initially with Northern Rock, and then an American crisis with all the problems over with Bear Stearns and so on. And then, and it was not a crisis in the Eurozone, was it? And indeed, even actually in early 2008, Greek government bond yields, for example, were very similar to German government bond yields. And this was the crisis was a crisis of Anglo-American capitalism. Well, you can see this is the annualized 3 monthly rate of change of money. Relatively, it was slowing down a bit from very high levels in 2007. They got double-digit money growth in the Eurozone. Heaven knows what the Bundesbank thought about that. Anyway, they had these clear acceleration in money growth and then collapse. Okay, and the annual rate actually went negative in 2009 and 2010. Fits again, the recessions I would say caused by a collapse in the rate of growth. But this is the UK. And actually we went into it earlier than the others because of the Northern Rock fiasco. Now the question then is, why did this collapse in money growth occur? And this is really where you get to, I suppose, the most controversial messages in the book. In the 60 or so years up to 2007, 2008, banks had been growing their assets mostly by increasing their claims on the private sector, their risky claims on the private sector, and in particular their loans to the private sector. At the end of the Second World War, for example, in Britain, British banks' assets were dominated by claims on the state, though over 80% of total assets. By 2006, that figure was down more or less to zero. So, what then happened in the next couple of years was that this whole process went into reverse. The first shock was in August 2007 with the closure of the interbank market. That meant that those banks had been growing their businesses by borrowing from other banks and then making loans to the private sector. They had to reconsider their business models and their whole strategies and their attitude towards growth. And some of them had to think about stopping growth or even possibly shrinking their businesses. However, in the Eurozone, where the ECB was very, very helpful to banks, there was actually more lending in the year from August 2007 than the previous year. They surprised you, but that was true, and that's part of the reason why money growth remained relatively high in the Eurozone, and they regarded this as an Anglo-American problem and not their problem. The second big shock came in late 2008, and this is really the one where the controversy arises. Let's just look at these numbers. You can see these are the growth rates of bank credit to the private sector, most of banks' assets, not money. That's a different thing from money, it's on the liability side of the balance sheet. You can see these very high growth rates of bank credit to the private sector, UK up to 15%, Eurozone and so on, and then collapsing to negative numbers in late 2009. Not by the way, in 2008. It's still quite strong here, middle of 2008. Middle of 2008, nobody expected IMF, the IIS, etc. They didn't expect the calamity that was about to occur. Now, the second shock was this. And this is when we get into the controversy. September 2008, we had the Lehman crisis. There was then some problems at AIG. The central banks gave every impression of not knowing what they were doing. There was quite a good reason they gave this impression. They didn't know what they were doing. And they did various things that weren't stupid, but they then did something that was totally stupid. They said the reason that we've got this crisis is that banks have got too much risk on their balance sheets relative to their capital. You know, I showed you the capital asset ratio earlier. That wasn't true, but that's what they thought. And so we must make sure the banks have more capital. And you know, if they can't raise it from the markets, most of them couldn't raise any equity from the markets at that time, then the government can inject the capital. Now, look, if you're a shareholder in a business, you don't terribly want some big bully like the government to come in to dilute your interests. Anyway, obviously one of the results of this was a collapse in bank shares, and the value of banks has never recovered in terms of ratio to book where it was before 2007, 2008. But then even worse than that, they said, you banks have gone and you're responsible for this crisis, so you must have much safer balance sheets in the future. You must have much more capital relative to your risk, much higher capital asset ratios. They couldn't raise any capital, apart from the government, So what was then implied, you're going to reduce your assets, aren't you? You're going to sell off some securities. You sell securities to non-banks, the non-banks pay for them from their deposits, which go down. You're going to ask companies and individuals perhaps to repay their loans quickly, faster than was expected. So then people have to sell off a home, or a company has to sell off a subsidiary, and then it goes into a bank deposit which used to pay off the loan, and the bank deposit disappear from the economy. Deposit it goes away, money is being destroyed. When a bank raises capital, it issues new shares, possibly new bond capital, and then this is paid for by the investor from bank deposits, which again disappear from the economy. So the result of the raising of capital asset ratios was to cause a drop in the quantity of money. And I showed you just a few slides back that there was a clear relationship between the quantity of money and nominal national income. So this, therefore, was a vicious deflationary shock when all those problems were evident in newspapers and so on. It was a completely crazy thing to do. Now, anyway, let's then just move on and see what. This shows you there's not a lot more to say, and there's stuff in the book, and please get the book and read the chapters and the rest of it. This shows you America. There were some suggestions the reason for this was actually to increase credit availability. Look, the result was going to be, of course, that banks shrunk their risk assets and restricted credit availability. And this shows in America that there had been a dip in banks provide data on unused loan commitments. It actually had been, instead of growing, it was then static for a period, and then they made this change in policy and it slumped. So this really was the key reason why everything was intensified in late 2008 and early 2009, and why it then became necessary for the nuclear option, essentially large-scale money creation by the state, QE, and dropping interest rates to zero. A lot more to say, but anyway. The question then is, why did they do this, and who was responsible? Well, it's in the footnotes rather than the main text, but in my view, it's Ben Bernanke and Irving King are really the main culprits here. But there should have been enough. This sounds obviously very, very conceited. Who might say all this? But I'm sorry, it's true. They took these steps that were going to intensify the recession, and then it was endorsed basically by the G20, and the job of enforcing the higher capital asset ratios was given to the BIS with help from the IMF, and the IMF put together some numbers, projections of the future losses of the US banking system, etc. Projections, by the way, which are complete rubbish, and to then justify this policy. Now, but individuals don't operate in isolation. They obviously reflect an international climate. And I would say that the real problem here was that economists, and I really do mean the professional, so-called profession I belong to, had completely forgotten the monetary theory of national income determination, and many central bankers simply couldn't care tuppence what was happening to the quantity of money. And this is really the point of the book. It's really to justify a restatement of the quantity theory of money, and really to recall analyses by Milton Friedman and others on these topics. Now, I'm running out of time, so I will very quickly, I'll just polish this off anyway towards the end. So, this is really the punchline of my contribution to the book. The other contributors don't necessarily always agree. It was officialdom that caused the problem, not the banking system. You see, I'm really echoing exactly what Friedman and Schwartz said about the Great Depression. They said the Great Depression was a result of blunders by a government-backed institution, the Federal Reserve. It was not caused by the banking system itself, or by bankers, or by capitalism. It was caused by mistakes by government, by officialdom, by the mainstream interpretation points the finger at the bankers. I'm saying it's a good deal more complex than that, it is true that the kind of argument I'm presenting, which is, I say, as a kind of a repetition of the Friedman and Schwartz argument in a different context, tends to be supported by people who are in favour of the free market. And can I just finish by saying that I think that's the end of the presentation. Yeah. Well, I've got one more thing to say before I finish. This is very strange. You might think then that all's lost and that this is very odd. What's happened in the years since the Great Recession? The policy conclusion, policy prescription that I've just spent 40 years essentially advocating is low and stable growth of the quantity of money. Stable growth of quantity of money to avoid macro instability of the type that we've seen in the Great Depression, the Great Recession, and by the way also in the boom-bust cycles that we had in Britain, the Heath-Barbour boom, the Lawson boom, and so on. So stable growth of money will stop that. And then low growth to keep inflation down, ideally to achieve price stability. I don't deny that banks should have capital to cover their deposit liabilities, and ideally the cushion, and of course they should be making profits and paying dividends to shareholders, of course. But that's not the point about macro stability. And quite honestly, I'm very much in favour if bad banks have heavy losses, the managements and shareholders should suffer. I have no problems with that at all. What hasn't yet really had much comment is that we've actually, this is the period this is the annual growth rate of UK normal GDP. A very, very basic macro number. This is the huge instability of the 70s and 80s. Then we had the Great Moderation from 92 through to the Great Recession. This Great Moderation starting up again, back to a somewhat lower growth rate of normal GDP. If I were right about the importance of money, what would you expect to have happened to money at the end? This is very simple stuff. This is the standard. I've taken 6-year periods, going back to 1964. First period is not quite 6 years, but they're all 6-year periods. This is a standard deviation of money growth. Average is 5 in the whole period. Extreme instability in the early 70s. Instability in the late 80s. Lowest instability of any of these 6-year periods. And the instability of the chain of nominal GDP, lowest of any of these 6-year periods. I had a ding-dong with Skidelsky at lunchtime. I was told I was suffering from religion. Look, this is evidence. I'll stop there.
Well, thank you very much, Tim, for such an interesting presentation. Well, I'm sure that it's going to foster discussion. Well, it has already fostered discussion somewhere else. What I will do tonight and in the weeks and years to come. So may I just say that this is the first book of a series in a series that is called Banking Studies in Money, Banking and Central Banking. So it's the first of hopefully numerous books coming in the next few years. This is at the core of the mission of the research agenda of the Institute of International Monetary Research. I have the privilege to work with Tim at the Institute. He's the chairman of the Institute of International Monetary Research. It is established in Buckingham, affiliated to Buckingham, and located there in the Buckingham campus as well. So if you want to be in touch with us, please go to our website, which, if I may tell you, it may ring a bell. It's www.mv-pt.org. So yes, we do pay attention to the quantitative theory of money. And if I may just say one thing, Tim, because I don't want to take your time for longer. You may think that we are stating the obvious by saying that by analyzing monetary aggregates, that we want to pay attention to what's going on in monetary policy decisions. Well, unfortunately, we are very exceptional at the Institute of International Monetary Research, because not many people do. If you talk to central bankers, of course they claim that they do. Well, if somebody does it, it's not having any effect in monetary policy decisions, in my opinion. So, by stating the obvious, which is we should pay attention to changes in the amount of money circulation in order to understand what's going on in monetary policy decisions, we are being exceptional. Well, so welcome to exceptionality. If you want to join us, please go online and you can get our monthly newsletter. And we'll be very happy to welcome you to our new, our forthcoming conference in November. That is going to be about the excess in bank regulation. And hopefully that will take us to a new volume that we will be very happy to present next. If you enjoyed Tim's presentation, if you didn't have enough, you may want to join the University of Buckingham. And in particular, a master's program in money banking and central banking, the Institute is sponsoring. So sorry for the marketing, but please, we can't afford another crisis in the next few years, and we need to know more about monetary economics, the proper one. So thank you very much for coming, and again, thank you, Tim, for your presentation.